Hello, good afternoon, good morning, good night. That wasn't even the right order, but hello and welcome to the Capital Spotlight Podcast, episode 24, hosted by myself, Craig McGrouther, alongside the principal and founder of the firm, Rob Beardsley. How are you today?
I'm doing great. It's been a busy, what is it, a Tuesday? Yeah, it's been a nice busy day, but I'm glad to be here.
It's that time of year where days of the week get blurred with holidays smacked here between Thanksgiving and Christmas. We out here at Lone Star are working through the end of the year. We are busy as ever with a lot of exciting stuff going on at the firm, a lot of movement going on, but all in the positive direction, of course. We got a great show in house for you today. Little housekeeping items. So, first off, we'll get into this. So, housekeeping, excuse me, 1031 exchanges, a Pensford report, positive leverage, and nuances and misconceptions. How does one get into syndication? And then finally, importance of having a moat in your business model. So first off, housekeeping items. If you saw the Fund to Fun webinar, thank you so much for watching it. We hope that you found that useful. By the way, that hasn't happened yet, but hopefully it went well. If you want a distribution of the recording of that, please let me know and I can get that out to you. Did you have something to say?
I'm just laughing how we're kind of talking to our future selves, right?
Right. Right, we are. But if you want to watch the Fun to Fun webinar, which Rob absolutely crushed and brought so much knowledge there, paired with some great questions from the gallery, let me know. We can get that over to you right away. If you're looking for the document that was displayed on this show and then also on that webinar, please let me know. I can happily get that over to you. If you are looking to invest in any opportunities for 2023 tax purposes, whether you need to offset some taxable income perhaps, please let me know. Perhaps there's a way that we can help you out there and get you involved. If you know someone in that situation, let me know. If you're a fund manager or capital raiser looking to partner on an opportunity with a firm like us, please let me know. We'd love to share with you what we're up to, and what we've done in the last year in 2023 and before, and what our plans are in 2024 and beyond.
What happened to
Any
that
other?
big investor that wanted to come in for some tax benefits?
Pretty sure you got a very nice situation. Which one are you specifically
Oh, so
referring to?
so so he took our very generous offer.
Yes. Yeah.
Wow. Well, so for everybody listening, we make very generous offers and we're good partners.
Yes, we are good partners, and sometimes we ask, you shall receive. And you never know what kind of end of the year special, call it a Black Friday special, a Cyber Monday special, that you may get from just listening to a show like this. So keep your ears out and eyes open, and you never know what could come your way. Any other housekeeping items, though, on that front that you want to get off your chest?
No, no, let's get rolling.
Cool. So 1031 exchanges. So this has been something very, very beneficial for us as a firm to get equity into our deals. But Rob, why don't you give a high level overview to those who know nothing about what that is? That's just three letters, or sorry, four letters, excuse me.
For
Uh,
numbers,
Four
actually.
numbers. Yeah, I'm a little bit lost today. I apologize. So, uh, four numbers. Why don't we get into it?
Yep. So starting at the most basic level, which I'm assuming most people listening are not at this level, but we'll start there anyhow. 1031 exchanges are a tax deferred exchange where you can sell a piece of property and roll over the gain from that sale into a new property and actually defer paying any capital gains tax. So this is a very powerful strategy to defer, delay, avoid paying taxes for selling real estate. And this is something that some of our largest and most sophisticated investors do a ton of, especially when you talk about generational family wealth. This is a great way to grow and pass down the wealth through owning property and then selling it, deferring the gains, and going into a 1031 exchange and rolling the gains into a new property and just snowballing it from there. So that's in effect what 1031 exchanges are. Of course, that's very basic and there it gets into all these nuances and complexities and kind of loopholes and ways to make it more complicated. But that's the essence. It's a tax strategy. And the way that we've utilized 1031 exchanges in our business is through a tenancy in common structure, where you have basically someone who is interested. Let's say somebody owns a rental property and they no longer want to actively manage it. They want to sell it, but they don't want to incur the capital gains tax associated with the sale. What they can do is they can sell that rental property, enter into a 1031 exchange, and then 1031 exchange the gains into a tenancy in common, which would be basically a joint ownership with us in one of our deals. So they might have $1 million condo that they're managing as a rental, but then they can sell it and then roll that, let's say, $1 million into a $20 million property with us that we manage professionally with our team and asset management, construction management, everything, and they get to be fully hands off, similar to an LP. It's not technically an LP position because, again, they're owning the real estate directly, which satisfies a key requirement of a 1031 exchange. That's why you don't hear about people able to 1031 exchange partnership interests, right? So you can't invest in a multifamily or real estate syndication and then sell your interest in that syndication and then 1031 exchange that partnership interest. That doesn't work. But with a tenancy in common, the 1031 exchange investor owns the real estate directly with us, and we're able to manage it and everything and make it feel as if they're an LP so they can be very hands off. So it's a great way for someone to transition an asset from an active to a more passive capacity, or if they're already in a passive capacity in a deal, they can just roll over their interest or their tick interest into another deal with us or with somebody else. So they keep a lot of flexibility in this structure. So that's kind of how 1031s work at a more institutional level and where we deal with a lot of our uh, higher ticket clients that are rolling over very large gains, but it even goes down to small. I mean, I think we've done some exceptions for some kind of friends and family. We've done like 300K 1031 exchanges, even though our minimum is really more so 750 million. So it even works kind of at the smaller end. And then at the largest uh, sense, I'll finish with this, is we can actually 1031 exchange our deals entirely. So we can take the whole partnership with all of our LPs and we can roll that over upon sale into a new property, which is what we intend to do and try to do with every deal. So that way we can offer as much tax advantages to our LPs, streamline their lives. And of course, the benefit for us is we get to keep those investors with us as we move on to a new project rather than having to re-raise new equity all the time.
Awesome. And unlike if you're just a normal LP in our opportunities, you're kind of investing into a security. But when you're doing the 1031 exchange, you are directly owning the real estate. So I just want to hit that point again. So, and I just want to unpack a couple more things in regards to the 1031 exchange topic because I know you are such an expert. So let's say if someone was looking to sell, a house or a duplex that had 50% of equity in it. Let's say it's a $2 million property. They sold it for $2 million and they have $1 million there. How does it work with the transfer over? Do they have to have a certain leverage point or a certain leverage amount into the deal they're exchanging into with us? Could they, and is there any, I guess, qualification or I guess restrictions or requirements with matching debt and equity? Could you unpack that, please?
Yeah, so this is where it gets a little more complex and there's some gyrations. So if you take the duplex example where there's a $2 million sale price and there's $1 million of debt, in order to satisfy the 1031 exchange, that investor is going to have to roll over the entire 2 million in value. Certainly they have to roll over the million in equity, but they also have to roll over at least the debt amount, which is an additional $1 million. So if they're going to roll over that $1 million of equity into a new deal, then that new deal is going to have at least 50% LTV leverage, right? So the new deal is going to also have to have $1 million of debt attributed to that proportionate share of the deal. So, for example, and we get this question all the time from our 1031 exchange investors because it's critical for them to know the leverage that we're contemplating on the new deal, or we call that the up leg. So the down leg is the deal that they're selling as part of their 1031 exchange. And if they have, like you said, exit leverage of 50% in your example, they need to ensure that the deal that they're investing with us has at least 50% leverage in order to
Could it
satisfy.
be, yeah, could it be 30% or, could it be, I guess higher levered than 50%?
Well, sure. So if it's 70% leverage, then that more than satisfies the requirement to replace. And so just to break down the math, right? If we have a $20 million, let's say we're raising $10 million of equity to buy a $25 million deal. right? That's more than 50% leverage, just given those numbers, right? And when a $1 million tick 1031 exchange investor comes in, because they'll have 10% ownership, right? They'll be 1 million out of 10 million of equity. And then they'll also get their proportionate share of ownership of the debt. So in that scenario, let's say there's $15 million of debt, they'll get attributed $1.5 million of debt to their capital account, which again will satisfy their need to replace that $1 million of debt. However, it gets a little more complicated because there's ways to get around this. That boot, as they call it, can be satisfied not by debt necessarily. It could also be satisfied by equity. For example, if someone's selling that $2 million duplex and they have $1 million of equity and $1 million of debt, they could do a 1031 exchange into a new deal that's $2 million, and they could roll over their $1 million equity from the down leg, and then they could put a fresh $1 million of cash into the deal as well, and that satisfies the requirement. They replaced all the value of the original deal, but now they're at 0% leverage, right? They own the deal all cash, and it's still valid. You can do that as well because you replace the full value.
What if you are a situation where you just own a house for $1 million cash outright with no debt on it, but due to maybe some cost segregation studies that you've done before that, have kind of created a tax burden and liability, and you don't want to pay taxes on it, you want to just keep rolling and rolling and rolling to just avoid the capital gains on it, and then also the recapture potentially. What would that look like? Can you exchange that into a deal with leverage? Is it can you walk us through that?
Yeah, so if you own a house all cash with $1 million, let's say, the key is number one, obviously, it can't be your primary residence, has to be investment property. And then from there, it's very flexible. You don't have any restrictions. As long as you replace the full equity and value of that million, you're good, right? Because you're at an all cash position, there's no sort of leverage component that you're trying to meet or anything like that. So that's an easy scenario. It's so, as you know, we've had interesting circumstances with investors coming in with a certain debt ratio and leverage. We've been doing deals at lower leverage more recently. And so a 1031 exchange investor has had to add a couple $100,000 in cash to the investment so that they can get the values all to balance out and to fully replace the exit value on the down leg between debt and equity. So yeah, it's not like an all or nothing, and it's not a just debt replacement scenario, right? You can kind of tweak with things and get it to where you need it to be.
Gotcha. Understood. Can you kind of talk through some of the deals that we've done and some of the challenges we've seen and what we've been able to overcome to kind of ensure some confidence to someone who may be looking to make a 1031 exchange? Because you've gone through some high pressure environments where you've had to take you could not have taken no for an answer, and you really had to push through despite the market kind of changing in your face. So can you maybe share some of the battle scars and challenges that you've endured at your time there with Lone Star?
So 1031 exchanges are, like you said, definitely a high pressure situation because there's a time constraint associated with 1031 exchanges, actually fairly tight. So when you sell the down leg, you have 45 days to identify your up leg. So 45 days is quite tight. In the world of real estate, things move slowly. So 45 days is a tight window. And then you have 180 days to close from the down leg. So only 45 days to identify, but you can actually wait 180 days from closing the down leg to actually close on the up leg. So closing within the 180 days is easy, generally speaking, but identifying within the 45-day window is stressful for the 1031 exchange investor, which is why it's a very much so a timing thing. Our investors will reach out and they'll say, I have a 1031 need. I need to identify by X amount by X date. Do you have anything? And we might have a deal, we might not have a deal. And that's just a timing thing. And we try to provide information as quickly as possible and be timely and work with their restraints. The other high pressure element of a 1031 exchange is the consequence of the exchange not going through. So this is a huge, huge deal because if you, as a sponsor, we as a sponsor, if we bring a 1031 exchange investor into a deal, we're committing to them that we're going to be able to show up with the deal at the closing table. because they need that deal in order to consummate their exchange and to defer capital gains. And it gets even more serious because when you're in a 1031 exchange cycle, this could be the third, fourth, fifth time that they're exchanging. So they could have millions and millions of dollars in deferred taxes from sales that they've done over
Decades
years,
ago. Yeah.
decades ago, if you have a long chain 1031. And all that could get blown up if you are unable to close a deal. And because if you blow it up, then now you have to recognize all the gain. And so you can actually have phantom income that you owe tax on. Because if you have gain after gain after gain, the gain might be larger than the amount that you're exchanging. So it's a real huge risk. So with 1031 exchange investors, just like all investors, trust is everything. Because like I said, they're trusting with us to show up with the deal at the closing table and being able to consummate the close. And then at the same time, we're trusting them to show up at the closing table and actually show up with the money because that's a big chunk. If it's a million, 2 million, $5 million, that's a big chunk that we're anticipating to show up at the closing table. And if it doesn't, then we have to scramble, and that's no fun. So it's a big two-way trust that is really important. And yeah, to now explain the importance of it and the consequences, now let's talk about some battle scars. So,
Wait, actually, real quick before we get into battle scars, can I interrupt you?
mhm.
So what if you identify a property within the first 45 days, let's say on day 40, you identify a property, but you don't close that property you identify. What does that mean? How does that work?
So you actually are allowed to identify 3 properties in the 45-day window. So it's certainly wise for a 1031 exchange investor to identify 3 properties. If you're allowed to identify three, you should identify three strong candidates, and one should be your safety valve that you know is going to be there to close. Like it could be a DST, a Delaware Statutory Trust fund, because there's funds out there that are legally structured to be able to accept your 1031 exchange funds at any time. So if you really want to play it safe, you can use up one of your 3 identification slots on one of these receiving funds that could take your money no matter what. And there's very low risk of that falling through. So you want to do that perhaps, and then identify 2 targets that are legitimate targets. Like you said, if you close on something else that you didn't identify, that's not a valid 1031 exchange, and you're opening yourself up to an audit. So that I'll leave it at that. Obviously there's things that people do that we don't that we're not privy to and that we don't condone and we don't know anything
Or
about
recommend?
or recommend. But there's certainly there's sophisticated things that people do that uh, you know they're taking their a risk, if you will. So yeah, there's only so much we can say over this podcast could be so much cooler if we didn't record it.
We're thinking about doing a Patreon perhaps, or maybe a meetup where we charge people to hear really what we think all the time. Just
Yeah.
kidding. Yeah.
So anyway, that's I think that answers your question.
It does. Thank you so much. And I think that provided good clarity just to give people a good background and whatnot. And then give us some real life stories, if you don't mind, with what you can share in regards to maybe some ways we've been able to accommodate some big investors and been able to solve really big questions and issues, because not every syndication group allows 1031 exchanges. Not everyone wants them in their, I guess, their org chart, in their, capital stack and their deal structure. And then additionally, not every group can take it via tick, or, some people love the DST. We take it through tick, which is more common than DST, but DST has become more popular. But why don't you explain some solutions and things that you've done for people to really create a lot of value and build great relationships?
So the additional complication, and like you said, a lot of groups just say no to all this stuff. They go, yeah, 1031s, it's complicated. I don't need it. I'm good without it. And so we, for whatever reason, enjoy wading into complexity and figuring things out and making things work. So we started doing 1031s back in early 2021. And it was a big decision for us. Hey, let's go figure out how we can accept 1031s, make it all work, and put it all together. And once we cracked that code, it took about a year. So we started in 2020 to try to figure it out. closed our first deal with ticks involved in 2021. And then from there, we pretty much have had 1031 exchange investors via tick come in on almost every deal. So it's turned out to be an extremely valuable solution, brought in, tens of millions in 1031 exchange funds. So it's been great. So the complexity also is in the org chart, like you said, with the lender, because now you have complexity with the lender. Lenders don't love it. And some lenders just outright will not do deals with ticks. So that's a bummer, and that has burned us and has turned, that has made us have to scramble for a new lender and things like that. But so it's a three-way negotiation between the tick investor or the 1031 exchange investor, we as the sponsor, and the lender. Because the lender, so here's a bit of complexity that can turn into drama. Tenancy in common means that the 1031 exchange investor owns the real estate directly. So a lender will say, oh, well, Mr. 1031 exchange investor, you own the real estate directly. That means you're a borrower. And if you're a borrower, I need to underwrite you as the borrower, and I need to do a credit check, background check, all that stuff. And I need you to sign on the loan because you're the borrower, right? So a lot of times lenders will ask not just us as the managing member of the main entity that's a tick to sign on the loan, but they'll also ask the managing member or the warm body associated with the managing member of the tick entity for the 1031 exchange to also sign on the loan. And this is problematic because nobody wants to sign on loans. And it gets even deeper than that because you open up all of these arguments like, well, hey, if I'm $1 million 1031 exchange investor on a $20 million equity raise, why should I sign on the loan and take 100% of the debt risk when I'm only 5% of the deal, right? So there's all these negotiations and back and forths. And so what I'll say is we've been all in all very successful and have a lot of experience now at this point in negotiating back with lenders and saying, no, you shouldn't need this requirement, or you need to scale this back or remove the need to sign on a loan. So we pretty much, and this is not stuff that I feel comfortable talking about just because it's legal structure that we don't want to open up to the public and scrutiny and stuff like that. But we've developed structures where we obviate the need for the 1031 exchange investor to sign on a loan in pretty much all circumstances. But there's still some circumstances where it's a little bit of a thumb war and we have to fight over some things. But as long as we have a reasonable 1031 exchange investor, we know what lenders are going to do, and we know who to work with, so it's all pretty smooth. So yeah, not too much of a specific battle scar story, but there's something else. There's another story that we could talk about, which I'm not sure if you're thinking of, but we can get in there as well.
Well, I have one story to think about before we get into what you think I'm thinking about. Maybe it is what I'm thinking about, but I don't think it is what I'm thinking about. With that said, a deal that we did that was kind of a privately done deal, which was something a bit out of our wheelhouse, which we've talked about, I believe, on the show, which was the closing of Azul, which is just a small 90-unit deal. Was that what you're referring to, or is that something else?
No, but I was going to bring that up at some
Yeah.
point as well.
Yeah, so Azul is a really sweet little fun deal. It's something that we've kind of talked about on this show before, which is, hey, what do we want to say yes to? So this deal was kind of different in the sense that it was a small 90-unit deal, but it was a 2020 build right next door to Park at Champion Forest, which sits nicely in our Houston portfolio. And we would not have bought this deal normally, but it was too good of numbers. And with the debt and whatnot, it was kind of a how could you not situation. So we ended up acquiring that deal. The amount of equity for this deal was 5.5 million, in which we found that equity from 4 1031 exchange investors. It was very simple. On my end, maybe on your end as well, but it was actually kind of a nightmare on the team's end. Hello. It was a nightmare on the team's end. Unfortunately, just due to the fact that there was some delays, there were some lender issues. It was nothing really that the lender did wrong or was delaying on. It was just a unique situation with the seller due to the mom and pop nature of that transaction with who they are as operators. But it was a great deal nonetheless. But with that said, that was a really cool opportunity where the capital stack was entirely of 1031 exchange tick investors, which was just really special. If you want to add a little color to that as well.
Yeah, that's kind of in my eyes finishing school or the coming out party, the culmination of our 1031 exchange strategy, where we were able to do a deal entirely with 1031 exchange partners. And like you said, that's super nice and smooth because what's cool is if we're going to go through the hassle of setting up the 1031 exchange structure for the deal, well, it's great that we could duplicate those efforts across multiple exchanges, right? Because if you're going to do one exchange, you might as well do a couple on a deal and make it all work with the lender. And at this point, our team is very well versed in how all this works. Like Dasha knows exactly what information to gather from the 1031 exchange investor, share it with the lender, get all the approvals, get all the documents signed, easy. So yeah, and then just repeating that process across more multiple exchanges on a deal, I think was pretty smooth. So yeah, that was definitely an exciting way to go about that deal.
Absolutely. What was the fun one that you had in mind regarding something that was, I guess, pressing?
Yeah, so this was the closing of Briar Court and Five Oaks. And that occurred in somewhere around the middle of 2022 when interest rates were extremely volatile and the capital markets were changing rapidly and the Fed was raising rates every week. And so it was a tricky time to close. And we had some 1031 exchanges going on those deals. And the crazy thing about that situation, I don't know if I'll ever forget because on a Friday morning, I got a phone call from, well, I can't remember in which order, but I'll tell the Five Oaks story first. So Five Oaks story first is everything's going smooth. We got this great loan with a new lender set up, and we're excited about everything. And they actually, the new lender flies to New York to come and meet with us. We have a meeting goes well, and they basically just said like, "Hey, this meeting is just to kind of come and get to know you, say hi, no big deal." So we didn't really think that the meeting was going to make or break the deal or anything. We had no issue, and we just thought we were going to close the week after. But we have the meeting, and then we were supposed to close the next Friday. Then on Monday, the lender is basically out. They didn't like what suit I wore at the meeting or something like that, and they just said, nope, canceling the deal. So they came up with some lame excuses as to why they weren't doing the deal, but we had a feeling that basically the lender was concerned about what was happening in the market and they just wanted to pull all real estate exposure. So they were just canceling deals. We kind of heard that they were canceling their entire pipeline and just rescinding term sheets. I mean, this is unprecedented stuff for a lender, and I'm not talking about just some fly-by-night bridge lender, like a legit bank to pull a deal within a week of closing, right? So this is crazy stuff. And we uh we had a huge issue on our hands. So I remember getting that phone call and be like, oh my gosh, we have to close in less than a week and we don't have a lender. And so this doesn't really have as much to do with 1031 exchanges, except for the fact that our biggest 1031 exchange partner on that deal, who's very savvy, very sophisticated, had a lot to lose, frankly, given the exchange hanging in the balance. And I saw a masterclass of tenacity uh, right in front of my eyes as he basically wouldn't take no for an answer, called the bank, asked to speak to the person's boss, the person's boss to the person's boss to like get to the top and kind of flex some muscles and basically say, you have to make this loan. If you don't make this loan, like we're gonna, say bad things about you, whatever. I don't know what really went on there, but basically we were able to convince the lender to end up coming back to the table, which in the end turned out to make it a really, really good deal because in the interim of not having a lender, we went back to the seller and said, hey, we don't have a lender. We need to go back out to the market. And debt terms are way different now than what the lender was offering us. So we need a price reduction. We got the price reduction and then we got the lender back to the deal with good terms. So we ended up closing the deal. And the deal looked really fantastic. And then on top of that, we got the property tax exemption on the deal, which we didn't initially underwrite. So then the deal is just stacking all these wins on top of it. So, sometimes there's good things happen for the good guys.
And I did actually make a very nice note that Five Oaks did get a massive cash out refi earlier in April, So can you share how much cash was tentatively given back to investors percentage wise on that opportunity?
I think 30%. Is that right?
Not nominal. Yeah, it's about right.
No, it's pretty sweet in this environment as well. So that worked out. But so that was like Friday number one. Then the next Friday, I get the phone call from the Briar court lender saying they're pulling out as well. And this is just another nightmare. Oh my gosh, week to close, we don't have a lender. Same thing. And at this point, I'm numb to it. It's like I can handle any bad news. So now, whenever you see me not stressing out over deadlines or investors backing out, lenders backing out, the world falling apart, it's like we've seen it all.
Nope. Yeah.
It's fine. It's all good. So with Briar Court, they pulled out. Same thing happened again. We were able to convince them to come back under different terms, in particular to personal guarantees and things like that. So not fun, not pretty, but that's the things about real estate that they don't talk about, that they don't teach you about. Everyone just says, "Oh, it's simple. You buy the deal and everything's easy," but it's messy and it's ugly and there's negotiations and there's people involved and you want to be good to your partners because then in times of need they hopefully will be good to you. So that's my little uh, highlight there on those two exciting things happening last year.
Yeah, and do you think, it's funny, there's just not a lot of transaction volume this year, so this probably was a historically low year for 1031 exchanges, would be my guess, and also kind of a funny situation too of debt being so attractive before and leverage being so unattractive this year. Probably maybe the worst year possible for 1031 exchanges with those two dynamics working in real time. But I do believe, and this is my prediction, I'd be curious to know yours, that the uptick of 1031 exchanges will probably start occurring in 2025 again. I don't know if next year will be as much just due to volume maybe not being there or equity being eaten or people just wanting to stay put with interest rates. But my forecast and projection would be that, hey, 2025 and beyond, there'll be more 1031 exchanging going on and likely just more velocity in the market and turnover on deals.
Yeah, I completely agree. When the market's down, there's less transaction activity. If you are thinking about you only think about a 1031 exchange if you're selling a deal and you're making money, right? If you're selling a deal at a loss, let's say, there's no capital gain, so you wouldn't 1031 exchange that deal anyway, right? And so there's just not a lot of people that are going to be selling deals for a gain in 2024.
Absolutely. So, can you also explain the value of 1031 exchanging with us from deal to deal? So, and the way I want to think about this, if you're an investor or a fund manager or anything like that, and a way to convey it to your investors would be, listen, imagine if you could buy stock A and sell it for stock B, but then not pay any capital gains. Well, that's effectively what could happen if you work with us from deal to deal. If we do like to 1031 exchange from offering to offering, right? So can you maybe just explain the value of that and how that extrapolated over, maybe a decade or so can really make us more competitive from the syndication perspective as opposed to the traditional stocks and bonds and, S&P 500 option?
Yeah, so it's really, I mean, I think you pretty much explained it. When you 1031 exchange from the deal level, right? So a 50K investor with us could benefit from the 1031 exchange strategy by, let's say they're 50K, let's say it's a great deal. Over 5 years, it turns into 100K. And then instead of selling and taking that 100K as cash and then paying a tax on that or recognizing the gain, they can defer recognizing the gain and paying any tax by taking that 100K, rolling it in to the next deal that we're doing. So if we bought the deal for 20 million, sold it for 30 or so, and then we're buying a new deal for 40 million, and then we're rolling over the investors that want to roll over from this previous deal, and then maybe raising some fresh equity as well to buy the new deal, investors can just simply opt in. And it's really the most efficient way for them to invest. And it's better than investing and having a long-term hold because a long-term hold, there's only so much value that you can create on a longer term hold. And so when you talk about development or value add deals, the value creation curve is like this. You create a lot of value up front through your business plan, and then the value accretion is modest thereafter. It's basically just market, right? It's just the beta growth. So as a passive investor, if you can sit back, do no work, but benefit from the growth curve of the upfront value add, and then sell 1031 exchange into another growth curve, right? So as a sponsor for us, it's also good. Or well, let me before I talk about it from the sponsor perspective, if you're your own investor and you are, let's say, buying your own property to do fix and flips, we all know how much fun fix and flips are, right? You buy the house, renovate it, divorce your wife, and then sell it and hopefully make a profit, right? So fix and flips, that's an active business. That's a lot of stress. That's a lot of work, but it makes a lot of money, a lot more than buying a rental and just holding for 20 years, right? So that is uh, hard to compare apples to apples. But what you can now compare is as a passive investor, if I can sit back and invest as an LP, do no work, and then the sponsor does all the work of essentially flipping, where they buy the deal, value add it, sell, 1031 exchange, value add, and so on, you're going to get a really, really strong compounded return that's tax deferred over a long period of time.
Awesome. We really hit this topic on the head. So that's great. Do you want to show real quick, prior to departing from this topic, the document that we have, maybe in our Dropbox? And for anyone who is looking to learn more about 1031 exchanging, if you are looking to conduct one yourself, or if you know someone looking to do so, please reach out to me. My email is craig@lscre.com. Once again, craig@lscre.com if you're looking to conduct a 1031 exchange. And always, if you're a fund manager or capital raising partner looking to partner with a sponsor like us, would love to connect with you as well.
Yeah, I mean the our 1031 exchange guide is nothing fancy, not as fancy as our fund to fund program document. So I don't think I'll share it right now, but just know that it does exist. And if you want to learn more about our 1031 exchange strategy and program, you can reach out to us and we'll share that guide with you. We'll jump on a call. We'll share with you what's in our pipeline that is eligible for a 1031 exchange.
Thank you so much. Do you want to get into the Pensford article now, which I'm sure you will do such a nice job of sharing? I
Yeah,
can send it
sure.
in the chat if you'd prefer.
Yeah, I'll go ahead and share my screen. So, as we all know, I enjoy reading the Pensford letter. I don't enjoy some of his off-topic antics, like saying
Eagles
bad things,
football.
yeah, I don't watch football and saying bad things about New York City here. No, thank you for that. But otherwise, good stuff. So he's been beating the drum that I've been beating for a while, which is talking about the fact that this robust labor market that we supposedly have is not as robust as people think. And the reality of rate hikes is it takes about a year for rate hikes to be felt, for their effects to be felt in the real economy. So for everyone who's banging the table and saying we need to raise rates still more because the economy is still hot or labor market's still strong, we have a resilient economy, unemployment's low. Some of that is true for sure, but it's only a matter of time until the dramatic rate hikes that have been done are going to take full effect in the real economy. So you're already seeing things slow around the world. As highlighted here, Japan's GDP contracted 2.3% in Q3. That's a big deal. That's a big contraction. So, like I've been saying, I I think we're going to have a recession, and I don't necessarily think it's going to be a soft landing. The stock market has been performing quite well over the last couple weeks, and I don't know if we talked about this last show, but while I was in Chicago for AHF, Treasuries fell 20 bips. Is just hallelujah, right? So basically, what happened was inflation data came in weak, so people felt that that was a signal that was enough of a data point for the Fed not to raise rates anymore. And the market took this big exhalation and said, okay, well, Fed's not going to raise rates anymore. And they bought a ton of treasuries and they bought a bunch of stocks. And so both appreciated a bunch. And I don't really buy into that sentiment. I mean, I buy into the sentiment that the Fed's not going to raise rates, but the market's way, in my opinion, way overselling the concept of a soft landing. And I think earnings are going to deteriorate. So I think stocks are going to go down quite a bit in 2024. So, I mean, Am I an expert? No, but just looking at some of the things in Pensford's letter, most recent letter, looking at Black Friday,
I saw
25%
some
of
pretty interesting stats, by the way, regarding Black Friday and how some groups, people now, maybe like 20 something percent are not going to buy gifts this year. Another 25% of them are leveraging credit cards or opening up new credit cards for that. And, frankly, why is that important to you? Why are we talking about this? Because we're in the multifamily business, which means those are our tenants. And that's probably a very good tracking and idea and understanding of how a lot of people are kind of doing right now, how most of America is, frankly. So these are just great things to think about and look at. Oh, and there you go. You have that information in front of us. So if you want to, yeah, 25% of all consumers still have credit card debt from last year's holiday spending.
that's hard to
So
believe. That's so hard to
what do
believe.
you think? Yeah, the interest rate of that is as well, 20 plus APR.
It's 30. It's insane.
20%, yeah, 20% will apply for a credit card to pay this year's holiday shopping. Now, there is exceptions to this, as the credit card hacker himself, Todd Beardsley, shout out to TB, would say, hey, if you are opening up a new credit card to get some points, maybe some airline mileage, whatever it may be for a future trip, hey, not the worst idea. If you're going to spend, a couple $1,000s that you're going to spend anyways, maybe you got to throw it on there. So that's likely not what makes up the entire 20% here. But maybe I'm just trying to get the benefit of the doubt. 1/3 of foregoing holiday present or foregoing presents entirely this year. That's really sad to hear. That's
One in
bigger than
three.
I quoted. That's nuts. And then 20% said they would spend less than last year, which makes sense.
Yeah, that makes sense. So, I mean, that's just some recent consumer data.
Well, and
On
I
the
know, yeah, and I know how I'm spending. I'm definitely a little bit more tight with dollars right now than I have been before the last couple of years, naturally. And then it's funny, and this is something to think about as well, is restaurants, right? You go to restaurants. Sam Silverman and I actually spoke about this on the Fun Friday show too, with how the economy is doing. He said, listen, before there's just one restaurant specifically in Tampa that you couldn't get a reservation for a week on a Friday. You'd have to book it out pretty nicely in advance. And he said he just walked right in, no problem, and was able to sit at a pretty good table without any issues. So that's definitely one place we're also going to see it as well, is for sure dining out, and just a little excess or unnecessary spending is for sure going to get cut, which will slow and soften the economy.
Yeah, yeah, I think there are leading indicators that, like we're talking about right now, consumer data is maybe not necessarily, I don't know about necessarily being a leading indicator, but it's definitely more of a leading indicator than labor statistics. Labor statistics are a lagging indicator. So when everyone's pounding the drum of a strong labor market and pointing to our low unemployment as to why we're not going to have a recession, they need to understand that historically speaking, you don't see unemployment go up until rate cuts start happening, because that's how long of a delay there is from the hikes to then have an effect on the labor market that you're already starting to cut, right? And so typically cuts start happening 8 months. I think it's 8 to 14 months after the last hike. So, I mean, we're on the clock for cuts. I think cuts are going to start in Q2 of 2024. And around that time, also, we'll start to see the effects in the real economy of all those hikes, and we'll start to feel the pain of the tight monetary policy. So, yeah, what else is interesting here? There was something else that I quite liked, but go
And,
ahead.
and while you pull up that too, it's something to think about on our end. And we've kind of touched base on this with more options coming up in our spot, where there'll be more deals than time, right? There'll be more deals than money we could raise for, which means we have to be selective with what we elect to go forward with. And one thing that we want to be selective with and going forward with, and definitely a indicator of things that will make us excited, and properties get us excited, are incomes. So trying to find properties with median incomes that are higher, with solid jobs, gets us really excited. And that likely means not doing, C plus or C asset types, but probably B plus, maybe even A minus, due to a stronger tenant base and, getting deals at, pretty favorable cap rates, right? So that's something that we've been thinking about. And as the economy continues to change, that is certainly, going to be a point of emphasis and focus. If we're looking at two deals, one with stronger incomes, maybe one with less stronger incomes, even if the deal with stronger incomes maybe has a little less upside, my guess is that, with us being the business of wanting to sleep better at night, over these next couple of years, those will likely be the opportunities that we will want to be pursuing.
Yes, I totally agree. And that's something that we talk about all the time. We think that Texas multifamily long term is going to do incredibly well, but over the next couple of years, we think it's going to be a bit of a softer period of time. That doesn't mean we're going to dramatically change our investment philosophy or thesis, but we're cognizant of that. And we're also cognizant of our continuous desire to underpromise and overdeliver. And that's not an easy thing to do if the market is working against you, right? It's a much easier thing to do to underpromise and overdeliver when the tide is rising all ships and rent growth is outperforming your expectations. But if we're going this way and rents are going backwards and concessions are going up and vacancies are going up, it's harder to underpromise and overdeliver. So something that we're doing to combat that is getting extra conservative, especially on the first couple years of performance, and making sure that we have enough contingency budgeted for unexpected expenses or worse than projected occupancy and things like that. So again, it's not getting pessimistic and throwing the baby out with the bathwater and saying, oh, well, we should put our exit cap rate to 8 and our vacancy to 10 terminally, and nothing's ever going to get better, because then, of course, you're going to stay out of the market and you're not going to buy a deal, right? You have to have courage and capital to take advantage of a difficult market. So we know we need to step forward and invest, but we need to do so in a way that protects ourselves and doesn't put ourselves in trouble or puts ourselves in a situation where we, let's say, project to investors that in year one, we're going to produce and distribute 5% or 6% cash flows and then only end up distributing 3. That would be a bummer. So we try to prepare and avoid that as much as we can.
Well said. And yeah, well said. I have nothing else to add to that.
Yeah, the last point on the Pensford letter, it's a very nerdy point, but the Jolt survey, which is, and I don't understand how anyone ever took this seriously, but it's a survey that goes out to employers, or I guess it surveys like Indeed and job posting sites, and it looks for open job positions. And it's a way to evaluate how tight or loose the labor market is. So theoretically, if there's a ton of job postings out there, a bunch of people are looking for jobs and they're not being filled, that means it's a tight labor market, right? Everyone has a job basically, and employers are struggling to hire. They have a bunch of job postings out there because they're looking to hire. But this is a terrible indicator, because if a company is hiring it for a new position and posts a job post and then they fill that position, are they always going to diligently then remove that job posting and just say, no, job is filled? I mean, that doesn't exactly work. So number one, that's faulty. Number two, the participation rate of these surveys is extremely low. And it's now coming to light that it's now like a 30% participation rate, and people are starting to walk back on the importance that they're placing on the Jolt survey, which, if I'm not mistaken, the Fed was actually leaning heavily on this and saying, oh, well, we have 10 million open jobs. The labor market's super strong. We need to actually curtail the strength of the labor market, with the thought being, if we have all these job openings and the labor market's very tight, that produces inflation. Because if employers are competing for a limited supply of employees, they're going to be willing to pay more for those people. And then now you have wage inflation. And with wage inflation causes general inflation in the economy, which is exactly what the Fed is trying to combat. So I get where they're coming from. And uh, that's, I get where they're coming from. But again, that's not exactly what's going on. I mean, if anyone in the, especially white collar, for most white collar positions, there's a recession right now, and it's employers have the power. I mean, we're
Well,
hiring people right now.
Tex was getting hammered. Technology and whatnot has been getting hammered since 2021. Like 2022 was not the best year for tech. 2023 has not been the best year for tech either. So, and also tech, it's really interesting though. I think it generally is good for that industry. It's gonna be a slight tangent, but the kind of arms race that was well discussed on All In podcast of hiring and all these days off and flex work. Basically the employee had so much power, before, and that is certainly shifting as people are a little more desperate for, fighting for, I guess, jobs that may be evaporating in this environment. So that's kind of getting reset in real time, right?
Yes, exactly. So tech has been in a big recession for a while now. There's not much hiring going on there. Real estate,
I
I
mean,
mean,
when's the last
finance.
IPO you've heard, right?
Right.
There hasn't been really any, cool or fun IPOs of late that I can recall that's been really beneficial. So IPO market in 2023 was really, really tough. Hopefully 2024 will be a little bit more fruitful in 2025 as well. But that has been interesting to kind of track and monitor.
Right. So, there's always nuance and there's a bit of a tale of two cities in the labor market because you have more blue collar jobs and skilled labor, unskilled and skilled labor, right? There's a lot of actual wage inflation, and that's what we're experiencing and what's hurting us on our payroll side at the property level when you're talking about leasing agents, maintenance, property managers, and things like that. So we have to be cognizant of those costs going up on the expense side for us in our properties, our portfolio, and our underwriting. But then when you look at kind of more like office jobs, white collar work, whether it be in tech, real estate, finance, things like that, it, I mean, people are losing their jobs right now and it's very difficult to hire. So what's interesting, just another perhaps a tangent for us and for everybody else out there, right now is a great time to get great talent because if you are looking to fill a position that is in that category where there's a recession, essentially, you can hire somebody for less or hire really great talent that otherwise would be unavailable to you. So we're in the market right now. We're hiring a controller, which is a very important position, a senior position. It'll actually be one of the most senior positions that we've hired from the outside. Uh, we have senior people on our team, but we've kind of promoted them from within and they've started here and they've grown. But we're kind of, bringing somebody on at the controller level is a big deal. So, and right now is a fantastic time to do that. So Kent, I was just in his office and he was just telling me how he's kind of honestly overwhelmed by the number of qualified applicants. And he's like, I'm trying to cut people out, but I keep having these Zoom interviews and they keep going well. And I need to invite them to the office and come see them in person. So unfortunately, we're going to be bogged down with a bunch of in-person interviews all week, but we need to do it.
First world problems and great problems of growth here going on while so many groups are contracting and figuring out how are they going to navigate the next 2 years. How are they going to keep these properties alive and kind of give them some CPR mouth to mouth to make sure that they don't go under. So hey, it could be a lot worse. Really, really, really sad that you have to interview and hire a more senior person to a growing firm. Really tough times for you.
So so you wanted some juicy drama, and I'm unfortunately I don't have anything super juicy for you, but I was lurking around on Wall Street Oasis as one does, and I just came across an interesting thread where someone said, "I just got let go. Me and my whole acquisition team just got let go. We're at a small real estate shop, and the whole acquisition side, we hadn't bought a deal in a year, and we were helping on the asset management team, but there was just not enough work to go around, so they cut everyone on the acquisition side." And the thread was people were saying, "Hey, sorry to hear that. You know, such a bummer thing to do before the holidays and stuff like that." But also a lot of people were replying saying, "Yeah, same here," or "This is happening at my firm as well." And so, yeah, in real estate in particular, which is the industry that we know best, I think there's going to be quite a bit of layoffs coming as well.
I mean, for sure. I'm consistently getting on my end when we do kind of deal send outs for when we have a new offering. Uh, sending out an opportunity to people and then getting the email, hey, this person no longer works here anymore. And then I have to figure out the new point of contact is, scrub an email, swap things out. So to your point, I am most definitely witnessing that on my end when we do the outreach process and whatnot. So it's an interesting time. And also for those who are kind of more boutique capital raisers and stuff, hearing a lot of stories right now of deals that are not going too well. And the deals that are not going too well, we're talking about deals that might have their equity evaporated or deals where their equity is potentially tied up for 7 years and they're kind of in as you call it, I believe, a zombie deal where it's just not really distributing. It's basically it's partially dead, it's partially alive, but it's very interesting times for sure as people are definitely feeling the pain and some deals are struggling and I think a lot of groups are just weathering for the fact that they might do less transactions next year, and if they're going to do less transactions next year, why are we having such a big and filled staff, right?
Exactly. Exactly right. Yeah, a zombie deal, like you said, would be it's not distributing. It doesn't have positive equity, but you're not giving the keys back. You're just trying to nurse it along and hopefully get to a positive equity position at some point.
And speaking of positive equity and getting that position, let's talk to and transition to the next topic, which is positive leverage, nuances and misconceptions. So I think this is topical considering maybe what we're dealing with potentially on a new acquisition in San Antonio, or am I off base?
I mean, every deal right now this is relevant for, and it's funny. So, I mean, we've talked about positive leverage on the show before. We've explained what that means and things like that. So, just to recap, positive leverage means your cap rate is greater than your interest rate. That's what it means. And so, if you have neutral leverage, so it- I don't have time to kind of pull up a spreadsheet, but it's actually quite simple calculations where if you have neutral leverage and you don't have any friction, so no closing costs and no fees and things like that, but if you have neutral leverage, so meaning your cap rate is 6, your debt is 6, your cash flow, no
Kind of
matter
like Azul.
yeah, your cash flow, no matter what leverage you use, is going to also be 6. So whether you use 50% LTV or 80% LTV, it'll be a 6% cash on cash. That's just how the math works. If your cap is 6 and your debt is 6, doesn't matter the leverage, it's going to be a 6% cash on cash. Now that, like I said, is assuming no closing costs and fees and below the line expenses and stuff like that. There's a drag there in reality. So if you are buying a 6 cap and you have 6% debt, your cash flow is probably actually going to be more like 5.5 or 5, just depending on the fees and things like that that occur below the line. So in a positive leverage scenario where your cap rate is 7 and your interest rate is 6, again, assuming no frictional costs, then the cash flow is going to be greater than 7. You're actually getting that's what a positive leverage, and actually you are going to get an 8% cash on cash. And in the scenario where there's positive leverage, where the cap is 7 and debt is 6, the more leverage you use, again, in the spreadsheet, not in real life, but in the spreadsheet, the more leverage you use, the greater the cash on cash. Even if you take it to 99% LTV, it'll be a 24% cash on cash or something like that. Now, obviously, that's not realistic. And in reality, there's risk and things like that. So that's not perfectly true. But in a world or in a situation where you have positive leverage, the more debt you use, the higher the cash on cash. And then, of course, the opposite is true as well. If you have a 5 cap and 6% interest debt, that's negative leverage. And so that's going to mean that at 75% LTV, you're going to have like 4% or 3% cash on cash. So that's the math behind it all. And that positive leverage term has been a big hot topic and a hot button for investors. And it's been an easy way for them to pass on deals all year long and just say, nope, not doing that deal. I need positive leverage, or I need 50 bips of positive leverage, or whatever their excuse is for not partnering with us because we're so wonderful and they should just partner with us. But the the nuance here is positive leverage doesn't. So when we kind of peel back the onion a bit with an investor and we say, okay, well, tell us more about your need for positive leverage. They'll say, okay, well, I actually don't necessarily need positive leverage going in. Like I'm okay buying a 6 cap and financing at a 6.5, so long as the business plan validly projects to get the stabilized yield on cost to 7, 7.5, or some positive territory, right? So that's one nuance is you don't, it depends who you're talking to, of course, but there are some groups out there that are pounding the table for positive leverage, but they also recognize the fact and are comfortable with going in at negative leverage and then working themselves up to positive leverage through the business plan. So that's one point. Anything else? Anything you want to jump in with?
Well, it's just funny, we have positive leverage now. and some nuances to it. When you have positive leverage going in on a deal, you can be a lot more levered, and you can a lot more easily hit your DSCR, your debt coverage servicing ratio, right? So you can easily get over that 1.25 threshold. But now we're seeing deals that are we have may or may not have a deal right now that's currently handsomely above positive leverage, and we can really max out proceeds and whatnot from the lender, and create a good situation. But now it's too levered, so it's just so ironic how some groups you can't win them all. Everyone has different wants, needs, and the goalposts from an institutional equity place and an investor place. It's always a fluid situation. It's always moving, and it won't be consistent as the market ebbs and flows and changes. All we can do is put together the best deal possible that we think makes the most sense, and find partners who feel as if our vision is met with theirs.
Yep, very good. And one misconception that I have kind of run into is people assume that if you have negative leverage, you have negative cash flow. So
Mm.
that's not the case. Negative leverage doesn't mean negative cash flow. Some people associate that and they think that, oh, well, if the deal doesn't have positive leverage, that means it actually doesn't have cash flow. So you can still have positive cash flow on a deal that's negatively levered, right? You can buy a 5 cap, finance at a 6, and your cash on cash might be 3. It's 3, which is not great, but it's not 0, and it's not -3, right? And then, but of course, that depends on how much you lever the deal. But of course, like you said, if you're financing with a long-term lender, like the agencies like Fannie or Freddie, they're typically going to constrain the loan proceeds to a 1.25x DSCR, which is a debt service coverage ratio, which means they need the net operating income to be 125% of the amortizing debt service payment, so principal and interest. So what that means is if you are buying in a negative leverage situation, but you are financing with a 125 cover covenant, you're going to essentially, from a cash flow standpoint, be constrained and operate at the same level of financial risk as you would in any other deal. So this kind of gets back to our conversation, I think, on last episode or the episode 2 episodes ago, where we talked about what would you prefer, LTV or DSCR? What's a better risk measure, right? And so the reality is you could have a deal that's 80% LTV and 1.25 DSCR, and you could have a deal that's 50% LTV and also 1.25 DSCR, which means that both of those deals, while they have very different leverage points, their ability to pay the debt service is equal. So I think that's pretty interesting and something that people don't fully appreciate or account for. So
And you would assume a deal that is the 80% point that has less leverage would likely be in
a
a
little
more
more
core
leverage.
market. Yeah, more leverage. Yeah, or the deal with less leverage, the deal that has more equity down would likely be in a more core market, perhaps. Maybe something that might have more appreciation associated with it. And the other deal might be more of a cash flow yield play. So that's kind of some of the nuances that you to look at when you are, assessing real estate. And the interesting thing tied together with the beauty of leverage right now, and maybe positive leverage, is the deals that were bought before with bridge and floating rate debt likely had negative leverage. And then what they're experiencing now is they're exiting in financial and capital market situations where the cap rates have really widened. Now, if the cap rates stay neutral or compressed from that point, they'd be fine. But due to the fact that the cap rates are widening, their equity is evaporating, and the deal may not even be worth a loan amount.
That's exactly right. So these things play out in slow motion, right? Distress doesn't happen overnight, like I like to say. So we've been kind of hitting on these themes and topics for quite some time, and it's going to be some more time before we really start seeing more of it play out in front of our eyes, right? There's been some early situations play out of showing this situation, but there's going to be plenty more of it where we're going to see that actually happen, where somebody bought a property for a 3 cap thinking they would. It's a double whammy because you bought at a negative, you bought in a negative leverage situation because it's a value add play. You financed with a floating rate bridge loan, so your starting interest rate was 3.5. Your going in cap rate was 3. So you go in on a negative leverage situation, but then your 3.5% floating rate went to 9.5. And so now your 9.5% rate is against your 3 cap, but let's say your value add plan is working pretty well. So you're up to a 4.5 cap. Let's say you smashed it out of the park, you're at a 5 cap. So now you have a 5 cap, which is your operating cap rate or your yield on cost, against your 9.5% interest payment. You're still upside down. It's still a mess. And that's where we're seeing the issues, compounded by the fact that that market might be a 6 cap market. So if your yield on cost is 5 and you can only sell for 6, that is impaired, that your equity is impaired. And depending on your leverage, if you have high enough leverage, then like you said, then all of your equity is gone. So at that point in time, you're not going to sell unless you have to, which of course, when you have negative cash flow, not negative leverage, negative cash flow, that is when you can become distressed and become a forced seller, because it's very difficult for a partnership to maintain feeding the deal via capital calls and manager advances or member loans to continue to pay the negative interest month over month and not necessarily see a light at the end of the tunnel.
And I will say this right now, if you're in a situation where you have a deal that may get capital called, really think twice about meeting the capital call and chasing good money after bad if it's for a one-off payment or two or quarter one-off payments, as opposed to getting the deal in a long-term stabilized situation. I can't stress that enough. That is what you want to be solving for if you're chasing good money after a distressed situation. So please, please, please consider that when you're making your decision, as that is going to be very valuable to consider. Am I going to get any dollars out of this on the back end of it? Or is this just gone forever? So consider that, because you need to understand the nuance of that, and hoping and praying for the interest rates to get better. Yes, I do think they're going to get better, but unfortunately, fundamentals may get worse coming up, which might negate that situation. So please, please, please think about that. Well, we're about an hour. Do you have any final thoughts today? I think we can save a couple of the other themes for next episode.
Sure, absolutely. Yeah, I was going to say just the fact what I said at our conference a month or so ago now, which is there is something worse than losing all your money, right? You can lose 120% of your money or something like that, right? So if you
You
put
can lose
in
it
100
twice. Yeah,
grand and then you put in a capital call of another 20 grand and then you lose all of that, it sucks to lose money in any situation, but looking back, hindsight, of course, being 2020, it would have been better just to lose the 100 grand rather than the 120 and not pony up the capital call. So, and we're seeing that, I think you and I read a quarterly report from a deal in Dallas that we became privy to, and we saw that the property's under heavy physical and financial distress, and they had a failed capital call. And so because they weren't, it's crazy stuff. I mean, they weren't able to actually fulfill the full capital call. And so they ended up deciding to just return all the money back to investors, because it's it's crazy. I mean, I get it, right? Because if you can't fully fix the problem, there's no sense in just throwing money at half fixing the problem. Because, like you said, just making a capital call just to pay a few months of interest or a year of interest, it's risky still, right? But to do a bigger capital call to right size the balance sheet by paying off the choking floating rate bridge loan into a lower leverage fixed rate loan, that can really save the day. Painful to do because it's a big capital call, but at the end of the day, if you own good real estate, it's better to right size the equity and go from, let's say, 80% leverage with the bridge loan down to like 60% leverage like this, and infuse more equity in a good quality property that you can hold and actually cash flow.
absolutely. Well, I love those final thoughts. We really got in the weeds on a couple of topics here, which I always like to do. I personally like that more, to go really deep versus just skimming over everything. Thank you so much for listening to the show. As always, if you have any questions about working with us here at Lone Star Capital, please reach out to myself. My email is craig@lscre.com. Once again, craig@lscre.com. If you're a fund manager, let me know. If you need the fund to fund webinar recording, I'll happily get that over to you. And if you need the 1031 exchange document, let me know. I can happily get that over to you as well. And perhaps there'll be an updating of that to make it as pretty and as aesthetic as our fund to fund model. Hopefully that'll be in the tickler file. We can unveil that maybe in the new year. But if you know anyone looking to 1031 exchange, or if you know anyone looking to make an investment, anyone who has any 2023 tax liabilities and needs to find a sweet way to maybe get some bonus depreciation and opportunity, let me know. Maybe we can work something out. Thank you so much for listening. We'll talk soon. See you soon.